why don't we go ahead and jump into the presentation? And I think it's time to get started with the proverbial risk disclosure. So we don't need to read every word of this out loud, but do take a moment to read what's on your screen. And I think the key element here is that there is risk of loss in trading futures and options, or really with any investment. Past performance is no guarantee of future results, and that all funds committed should be purely risk capital. More of the advanced option strategies made simple. So let's jump into that. Insurance companies make money, we all know that, and they do so by collecting premiums from us, more so than compared to the claims. So they are paid to assume and then manage what they would consider calculated risk, using all their actuarials and so forth, and statistics. And they would sell time and then manage that time. That's really what they're doing. But they also insure themselves with reinsurance and other ways, of course. They have a business plan where they are patient and consistent, and they know that the probabilities in the long run favor them. So speaking of probabilities, let's look at something a little more fun than insurance. How about roulette and being the house in a casino? Sure, we're all familiar with roulette and the roulette wheel. Let's say we're to bet $100 on 38 spins of the green 0. Probabilities suggest we would win once and lose 37 times. We would win $3,500. However, you would lose $3,700. And your net loss would be $200, which is $5.26 average per spin. So that is really the 5.26% house edge when playing roulette in the long run. So knowing this, the casinos are glad to keep playing as long as they can, even though they know that they will pay out winnings at times, and even sometimes large. All right, what about high probabilities with trading, what we might consider base hits, not home runs? Well, here's an analogy, another baseball analogy here. Here's Rod Carew, a batting champion with no home runs. Here's a guy that won the batting title with no home runs, and he won multiple batting titles with hitting hardly any home runs. Most valuable player, many, many years in a row, and just got me wondering, maybe we can do the same thing with options, get lots of base hits and not swing for the fences. What about collecting premiums, which we might call base hits? Knowing, we will occasionally pay out claims and strike out, of course. We'd have to be consistent and patient, manage our risk and reward, and we need the proper tools. And hopefully we end up with lots of base hits and the odds and the probabilities favoring us. But this gentleman here looks confused. He wonders, how can this be done? Where to start, what to sell, who to sell to, where do the premiums come from, which markets, what pricing, how to manage risk and reward. Well, let's look at credit spreads and maybe answer some of his questions. A credit spread is a strategy that collects option premium. These are insured positions. They have a maximum reward, which is the premium collected minus commissions and fees, and the maximum risk, which is the difference between the short and long option strike prices, plus the commissions and fees. So your risk and reward is predetermined in a credit spread. And also note that these spreads may be non-directional in nature. You might have a bullish bias or a bearish bias, but you can also have a non-directional credit spread, and we're going to look at some examples in just a moment. Now remember, these are all covered positions. They are not naked options. You don't want to be like this poor little feline here without any coverage. You don't want to be a naked cat here. You want your position insured. You want that your maximum risk is capped, and these are known as covered option spreads. And we're going to look at that. Here's a call spread. So you would sell a call and then buy a higher strike price call. That's called a bear call spread or a vertical. And this is a bearish to neutral stance. You collect premium by selling a call, and then you limit the risk by actually buying a higher strike price call for less money. So your reward is the net credit you receive minus commissions. And let's look at an example. I'm going to get the pin out here. The infamous highlighter. Here we go. So let's say we are selling a 28.75 call, and we're going to collect 4.5 points. So looking at the graph here, you can see here's, in this case, the E-mini S&P and what it has done in the prior, looks like about 2 or 3 months. And here's where it's currently trading. So then you sell a 28.75 call is represented by the red horizontal line. At the same time, you would buy a 95 call and you pay 2.25. And that's represented by the blue line. The net premium you collect is 2.25 on that spread. So that's what a simple call spread looks like. And let's go ahead and erase that. See if we can't look at some more of these examples. Then here's a put spread. You sell a put and then you buy a lower strike price put. And that's a bull put spread, a vertical spread. It's a neutral to bearish stance. You collect premium by selling a put, and then you limit your risk by buying a lower strike price put. And the maximum reward is the net credit minus commissions and fees. And oh, just a second here, I jumped the gun. I want to go to the next screen here. There we go. All right, so in this case, let's say we sell the 26.15 and we receive 3 points for selling that put. And here's the put we're selling. And at the same time, we buy the 25.95 and we pay out 1. And so we're buying the 25.95 put below the one we sold. So we receive a net premium of 2 points here, of course, minus commissions. And that is what selling a put spread might look like, in this case on the December E-mini S&P 500. Now, let's talk a little bit about those naked options again. Just a moment, let me erase this. All right. For example, this poor little mouse here is naked and he's having trouble. So we don't want to do what he's doing. We need to always be covered with our trades. And let me show you why. Let me get out the highlighter here. Well, before I do that, let me just do this. Let's say you're going to sell a 25.85 put. So the market's trading around 2,800 and you decide to sell a 25.85 put as represented by this red horizontal line. And then you do nothing and the market starts to drop. And for whatever reason, you decide you're going to hang on to that trade. Well, that was probably a bad idea because the market now is trading around 23.50. So the strike price of the put you sold at 25.85 compared to where we're currently trading is 23.50. Okay, and that means that option is in the money by almost, well, 235 points or almost $12,000. So you're actually sitting on a loss of almost $12,000 minus, of course, whatever premium you might have received, which would be very, very, very little compared to that loss. So the moral to that story is you need the insurance. You only want to be selling covered spreads. Naked options is unlimited risk. So in our example here, I'll just grab the highlighter. If you had bought at the same time the 25.65 put and the market just drop, and you did nothing, and it was still down here, at that same time, your risk would be the difference between the strikes minus your the premium you received, and of course you have to add your commissions in. But so I think 20 points compared to 235 points is much more palatable. But even so, just sitting on a trade and watching the market go through it isn't a wise move either. And we're going to talk about that and how we can avoid that. All right. Here is something called an iron condor. It's a non-directional strategy where you collect premium, and all you're doing is placing a bull put and a bear call spread simultaneously. So it's just the same order. So instead of doing the puts as one side and maybe later on deciding that maybe you want to sell a call spread or whatnot, you would just do these at the same time. And let's take a look at what that would look like on a chart. So it's non-directional. You want the index to stay between the short call and the short put. So here is what that looks like on a graph. Very simple. You have your call spread above the market and your put spread below the market. And the idea is that here's the market price when you place that spread and collected premium, and the market pretty much just went sideways, and that's really what you're after when you're selling premium. And we're going to talk about time in just a minute too. But what are the advantages of condors and credit spreads with stock index futures options, such as the E-mini S&P 500? Let's take a look at that. How about execution quality? Recent report called a cost comparison of S&P 500 related options. The ES options, which are the E-mini S&P 500, and those are futures options, they offer superior execution. And in dollar terms, these ES options offer cost savings of $4 to $15 per contract. So this is what they're referring to, the bid-ask spread on every transaction. Every transaction, there's going to be a bid offer, and you want that spread to be as tight as possible, and therefore minimizing your transaction costs, otherwise known as slippage in some circles. So these S&P markets in the futures option space are very, very liquid. They have excellent depth, liquidity, and execution. Now remember, we talked about delta and we talked about time. Well, let's get to the Greeks. It's as I say, it's all Greek to me, right? But in this case, it's real easy. Delta, one way of looking at delta is very simple. It represents the percentage change in option value compared to the change in the underlying asset. And we'll look at an example here. Then there's also theta, and that equals time sensitivity. And there are some other Greeks, but we're not going to discuss those at the moment. So for example, with delta, let's say the S&P is at 2940 and a 2890 put is at 15 points with a delta of 25%. And now the S&P drops 10 points. So what's going to happen to the value of that 2890 put? Well, we know it has a delta of 25%, so its value should increase by 25%. So the put would gain 3.75 points and now be trading at 18.75. So just that simple. Here's a few key points about delta. Any at-the-money option has a delta of 50%. Deep in the money is having a delta of 100. So basically like being in a futures contract. And then a deep out of the money option has a very small delta, sometimes something like 0.05 or 3 or 2 or whatever. It can be very, very small if it's really deep out of the money. It takes a very large move in the underlying asset to impact the value of a deep out of the money option. Now here is a really, really important key to delta. It also equals the approximate probability of expiring in the money. So with a 25% delta, that means there's a 25% chance of expiring in the money. But conversely, a 75% chance of expiring worthless. Now remember, delta is always moving with the underlying fluctuation in price of the underlying asset, and of course with time. Now speaking of time, let's look at theta. Remember we mentioned theta, and really that equals sensitivity to time. And time decay, let's talk about that. Every option is a wasting asset. It's a depreciating asset and has a limited lifespan. So we refer to time in the options world, or options parlance, as theta, expressed as a negative number representing 1 day of time decay. For example, premiums at 10 and theta is negative 0.05. The next day, all other things remaining equal, the premium will be 9.95, the day after that, 9.90, and the day after that, 9.85, and so on. Now remember, with theta decay, unless the underlying asset is moving favorably and quickly enough, every out of the money option will be 0 at expiration. So selling options, these credit spreads we're talking about, takes advantage of this theta decay or time decay. And here's what that looks like on a graph. Not meant to be too detailed, but just to get that point across and show that concept visually. But you notice in region C how the percent of the premium remaining starts to really, really fall off more rapidly. So as time compresses, the time value of an option will start to deteriorate more and more rapidly. So the whole point of trading credit spreads and being a seller and collecting premium is we want to be boring. We want to be one of these people who just sit around and twiddle our thumbs, and we're not looking for excitement. The goal is to sell out of the money spreads and watch time pass. So that's what we're trying to accomplish when we're trading and selling and collecting premium on these credit spreads. We want to be boring. But that doesn't mean there won't be some periods of, I guess you could say, some excitement. And when that happens, you need to be able to consistently manage your risk and reward, and perhaps even automate that whole process. And to do so, you'd want to keep your emotions in check and on the sidelines.